America's banking regulators have failed. Here's some things that can be done to improve regulation overall. The Federal Deposit Insurance Corp. Diffica logo at the DIFIC headquarters in Washington on February 23, 2011. Adjacent read Reuters. March 28 hearings on bank regulation exposed the shortfall of federal regulation. The hearings came in the wake of the Silicon Valley Bank Askeba failure and the stresses on other banks, like Signature and Republic. To put it frankly, the hearings exposed our regulators appear to be virtually useless. Among things we learned last week, we've long known the Federal Reserve, the Fed, assesses risk to certain large banks as part of its regulatory duties, but it emerged last week that the Fed's risk assessments took no account of the breakneck speed at which interest rates were rising. It turned out this was the SCEB's biggest risk. SCEB had invested its deposits in long-term bonds, but as rates rose, bond values declined and SCEB suffered unrealized losses on its bond portfolio. Ordinarily, since the bonds were intended to be held to maturity, that would not be a problem, as the bonds would pay off 100% of their face value at maturity. The losses were unrealized, according to Michael S. Barr, the Fed's vice chair for supervision. The Fed knew SCEB was at risk for rising interest rates as early as November 2021. Barr disclosed that SCEB rated a 3 on the Camel's scale, an acronym for regulators' assessments of a given bank's capital adequacy, asset quality management, earnings, liquidity, and sensitivity to the market. The Camel scale runs from 1, the best, to 5, the worst. So, clearly, there were early warnings, but regulators only asked SCEB management, which was, presumably, the Fed's failure to act avert the SCEB failure, or perhaps to seize it as interest rate rises first started putting its balance sheet out of balance, and points to significant regulatory failure, both by the Fed and the DFIC, which shares bank oversight responsibility. But sadly, this isn't the first such regulatory failure in financial oversight. The Lehman Brothers bankruptcy that triggered the 2008 financial crisis. Regulators missed what could only be described as blatant accounting manipulation. Lehman was able to make it appear that its balance sheet was more robust than it was by engaging in something it called Repo 105. Repo 105 allowed Lehman to sell $105 of its assets for $100 cash, but with the promise to repurchase or repo the asset at another date, hence the phrase Repo 105. An accounting rule at the time allowed the transaction to be treated as a sale, not as financing, as repos typically are. In Bernie Madoff's horrendous swindle of $65 billion from his investors, regulators at the SEC were warned repeatedly of Madoff's Ponzi scheme for nearly a decade, but refused to take action. An options trader at another firm, Harry Markopolos, who had been tasked by his bosses to replicate Madoff's seemingly superior trading strategy, realized it could not be done within minutes of reading Madoff's documentation. I read his strategy statement, and it was so poorly put together. Markopolos was quoted as saying, his strategy as depicted would have trouble beating his zero return, and his performance. There are a number of reasons for these failures. First, the regulators are mostly career civil servants who are not up to date on market conditions. Market innovations like Repo 105 or the securitization of mortgage securities can happen in days, weeks, months, or years before regulators catch on to it. Second, regulators in higher positions of authority tend to be attorneys who know the law, but not its practical application. They also tend to be less flexible. Harry Markopolos relates that one SEC administrator told him that he could not be a whistleblower, even though he had details of Madoff's fraud, because he did not work for Madoff's firm. Third, and sadly, there is a revolving door between the people who purportedly regulate financial institutions and the financial institutions they purport to regulate, as was illustrated in a tweet from Agnès Willows of a House Financial Services Committee hearing last September. As shown, Rep. Trey Hollingsworth Warren introduces his staffer to the president of Bank of America, noting that she will join the bank the next week. Bank of America's CEO chuckles and replies that her father already works for both.